Thank you, everybody, for listening to our webinar, recorded webinar today on the fundamentals of syndication investing. We have a great guest presenter today who's going to talk about some of the more basics of being a syndication investor, what that means, what that looks like, and give you some more information on kind of some of the key terms as well. If you're someone who's looking to get into syndication investing and maybe make that leap from being an active investor to someone who's a little more passive in general. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company since 2006. I've done a lot of different things here in my time at Advanta IRA, but focused specifically now and spend a lot more of my time on the business development side, overseeing our offices in Tampa and Atlanta, also trying to make and forge new business relationships with a number of individuals as well. If you have any questions at all on self-directed IRAs, you're always welcome to reach out to me either by phone or by email, whatever works best for you. I'm always available to answer those questions, whether you're an existing client or someone who's looking to get started. Certainly happy to answer questions on the ins and outs of self-directed IRAs and really IRAs in general as well. Just before we get started, I always like to put our disclaimer out there that Advanta IRA does not provide investment advice. We also do any legal or tax advice as well. And we certainly don't endorse any products. So when you're looking to make an investment with your self-directed IRA, it is up to you to do your own due diligence on the investment itself, the people you're investing in. But if you do need references to an attorney or CPA or financial advisor, someone to give you some actual guidance and some assistance, we can certainly give you references to those professionals as well. Just a little bit about Advanta IRA. We've been in the industry over 20 years. We have a number of different clients that sit in our Tampa and Atlanta office, but really how we set ourselves apart at Advanta is in two ways. One is in our educational offerings, which this recorded event is just one of many different things that we do. But we also really try to give every one of our clients really a personalized customer service experience with a concierge level of service for every investor, every client does get that dedicated account manager, that person who is a one-on-one contact for you. So if you have a question on your account or you need to make an investment within your account, you can reach out to that specific individual and get your questions answered. Like I said, though, our other kind of separator is our educational offerings. We do a lot of different events, usually 1 to 2 a week, whether it's our online webinars, whether it's our online networking events. Sometimes we do some live events as well. But we also have a video library. So any webinar, if you're ever looking to get educated on a specific topic, you can visit our video library, our Advanta On Demand channel on YouTube. Any webinar that we've ever hosted, we record, we place there for playback. So if you missed a topic or if you see something coming up that you're simply unable to attend, just know that you can go to our YouTube page and watch that at a later date. So we really, again, believe very strongly in giving that very personalized customer service experience, and then also giving our clients the tools and education they need in their investment journey. And again, so please check out some of our other events as well. If you're somebody who hasn't heard of self-directed IRAs, probably because most banks and brokerage firms who offer 401ks and offer IRA accounts limit you to what types of investments you can make within your IRA account. So they offer only those things that they sell. And so if you wanted to invest in real estate or private notes and mortgages and some of the other things we may talk about today, you have to have someone who's a custodian who's willing to offer that type of investment. So a self-directed IRA is one in which you have a much broader choice of different things to invest in. The IRS regulations that govern IRA accounts and the different things you can invest in with your retirement account allows for a very, very broad range of different types of investments, but not every custodian is required to hold every possible investment. So that's why banks and brokerage firms typically hold more conventional assets, and why companies like us at Advanta IRA, we hold the different real estate investments. When it comes to investing in real estate in your IRA, you can invest in rental homes, commercial property, fixer-uppers, condos, duplexes, land. I mentioned notes and mortgages. Of course, we're going to focus on today, and with our guest presenter, is really talking about multifamily property and syndication and what that looks like. And I think one of the good kind of internal analysis that each investor should have to some extent is really to kind of figure out what type of an investor are you? Are you somebody who is more active? Or are you someone who's passive? If you're someone who's active, you may be doing different rental properties or doing a rehab or doing more wholesaling where you are definitely in more control. You're the decision maker and being more hands-on, but it does obviously require more of your time and energy and potentially expense as well to be a more active investor and manage a rental portfolio or manage a rehab project. People who tend to invest more passively maybe choose investments like private placements or the syndications we're going to talk about today, where there's not as much time commitment. I think our guest speaker is going to talk about what's involved in being a passive investor. What type of time commitment do you need to present to this type of investment? But you're not bothered as much by the minutia. Some of the pros. Now the cons, depending on your personality, is when you invest in a private placement or a syndication, you give up a great deal of the control. That control is made by the managers and the investment fund itself. So I think in deciding kind of what type of an investor you are really can help guide you as to what investments you may seek out, even beyond your retirement portfolio, but specifically inside of an IRA account. It's not that you have to pick either or. You can certainly have active investments and also more passive investments. But for someone who's looking to just get started into investing, that's a good analysis to have to determine maybe what your first kind of foray is going to be into the investment community. So to talk really about passive investments today, we've brought on Whitney Elkins-Hutton, who is a director of investor education for passiveinvesting.com. She's also the founder of Ash Wealth and the Investor Accelerator program. You can connect with Whitney at put her email address on that screen. But this time I want to bring Whitney on, allow her to share her screen and share her slides and tell us more about kind of how she got into passive investing as well. So not only is she going to share some of the information on what are some of the fundamentals of syndication investing, but talk a little bit about her journey, because I'm sure her journey is going to be somewhat similar maybe in how it got started to some of you on the call. But Whitney, how are you doing today?
I'm doing great. Thanks so much for having me on. Such a
Great, we
pleasure.
appreciate. Yeah, absolutely. I appreciate you having on. So I'm gonna sit back and let you get started. I might pepper in some questions here or there as you go along. We talk about kind of your journey and, like I said, in passive investing in general. So at this point, I'll turn the controls over to you.
Absolutely. Well, thank you. Yeah, so Scott did a wonderful job of introducing to me, but I am the Director of Investor Education here at passiveinvesting.com. You can also connect with me at passiveinvestingwithwhitney.com. There, if you go there, you can fill out a short little form. You'll get a bunch of the free goodies that I mentioned today. You can also schedule some time with me. We can just get connected about what your real estate investing goals are and how passive syndication might fit into those investing goals. So happy to connect with anybody. I know people's time is valuable. But so, just a little kind of quick background about my story. I actually started off real estate investing in 2002. Totally by accident. Scott did a great job of kind of delineating the active investor versus passive investor. And what I was doing, living, flipping, and house hacking, it was very active. It was very hands-on. But it was how I actually had no intentions actually getting into real estate. I just wanted to buy a house and have a roof over my head. But it needed an intense rehab on the property. My relationship at that time had fallen apart, and I needed to get roommates in there to help pay the bills. Fast forward 11 months, I had made $52,000 profit when I went to sell the property. But what was even more wild to me is that I actually hadn't been paying for anything the whole time. My roommates had been covering all the expenses on the property. And I actually made more money in that year passively through my real estate investments than I did in my day job. And I was like, how many more of these projects could I possibly do? Not every one of them went very, according to plan. That is one of the pros of active investing, but also one of the cons, that you own the entire business plan. But fast forward a few years, I did really well building up buckets of equity, but what I didn't have was my time back. I had another job. And that's when my husband and I, we had done a few projects together at that point in time. That's when we kind of slapped ourselves in the middle of the forehead and said, you know what, we actually need to start holding on to these properties that we're rehabilitating and produce passive cash flow. off of these properties by renting them. And so we built up a portfolio of about 30 single family properties. And then we had our daughter. And I was like, I want to spend more time with her. I want to be at home. I had alien family members too. And so I was like, how can we start utilizing some of this passive cash flow so I can be at home with, loved ones? And my husband kind of came around. He was like, well, I want that too. And I'm like, wait a second. We didn't plan for this. We didn't plan to have 80 people or 80 single family properties, which was what it would have taken to get him out of his job. So at that point in time, we needed a different way to scale. So we did two things. We had a two-prong approach. One, we started, instead of buying single family properties, how could we get more doors with each transaction? So how could we start scaling through multifamily? Two, that meant we had to re-engineer every single system that we had: market, realtor, lender, everything, property management. And at that point in time, I had been introduced to passive investments, and where you can actually invest in a business operation that owns real estate, and the operators can take care of a lot of these moving pieces on your behalf. And we'll get into those finer details here in a minute. But fast forward today, we've scaled a passive portfolio of over 6,300 multifamily units. There's a little bit of residential assisted living peppered in there, and then over 1,400 self-storage units. But really what this passive portfolio has allowed us to do is produce a result, and that is that we have 100% control and freedom and choice of how we spend our time. We both still work. You're not going to find either my husband and I laying on a beach sipping margaritas, riding off into the sunset. We both very much are, still very driven people trying to produce an impact in the world today. But
so Whitney, if I can jump in, so your decision to kind of go from more active to passive was indeed lifestyles, either somewhat lifestyle change or life events that said, hey, you know what, I can't keep doing this particular, I can't keep going down the route of just rehabbing houses.
Right, it was a combination of the two, right? We knew we wanted to. I firmly believe that everybody should have controlled portfolio, like some single family properties, small multi, things that you hold title to, or either by yourself or in partnership, because now you're the day-to-day operator on the property. You have some control. You can dictate when you're going to refinance, when you're going to sell, all those sort of things. But we were sitting there on a buckets of equities, a lot of it actually locked up in our retirement plans, and we can talk about how we use self-directed tools here in a minute. But we couldn't get it all deployed as quickly as we wanted to. And so it was like, okay, how can we build this active portfolio but also scale really quickly on the passive side? Because that passive piece, and I'll touch on it here in a second, we were putting just a minimal amount of time in to do the due diligence on the operator, the market, and the deal. But after that, we kind of, that's the whole reason to do passive, is that you can kind of pass the operations on to somebody else because you're investing in a business. I don't know if you've ever seen Robert Kiyosaki's cash flow quadrant drawing. We were looking for a wheeze. When you're an active investor, you're self-employed. Okay, if you have a large business with 50, 60, 70 employees, now you have a business. You're on the right side of the quadrant. But when you're just running your active portfolio, you're on the self-employment side still. And to truly unlock passive income and that financial freedom and freedom of time, you got to figure out how to get to the B and the I side of that cash flow quadrant. And passive investing allowed us to do that. So naturally, one of the questions I get is, what is passive investing? And passive investing simply is, where a group of partners or investors come together to purchase an asset. And the partnership, when we're talking about a syndication or group investing, is typically split between the general partnership or GP and the LP, the limited partnership. Now, the general partnership, think of this, these are going to be the active operators. They're the ones that are going to be finding the deal. What you're doing is you're investing in the general partnership to produce leverage, and the leverage they bring is the knowledge and expertise on the strategy, the expertise on the markets. They're going to be finding the deal. They're going to have the networks and teams together. They're going to have the brokers, the property management, the lenders already in place. They're going to have the ability to secure credit and lending to acquire the loan on the property. So one of the big benefits to us, when we made this transition into passive real estate, is I didn't have to have my name on any more loans. That was amazing to me. They're also going to be able to tap into other investors' money to bring additional investor capital. That way you can take down a larger asset. We are super thankful here at passiveinvesting.com. We just closed our largest asset to date last week. And so, I mean, it just speaks to the power of being able to bring a group of investors together. And then for me, what was most important is that I was able to leverage somebody else's time to scale my portfolio. So while I continue to go find my active deals, I still do that today. My husband and I, we invest in short-term rentals, long-term rentals. We're starting up a camper van business. So we still have some of these active projects on the side, but the passive investments are what gives us a huge amount of scale, not only financial scale, but also the time. We're able to scale our time by investing in operating businesses that own real estate.
And I think when it's so key what you say, it's the time aspect of it, right? That like you said, you don't have to spend as much time on each individual deal. That's what I had one of our clients years ago calls it mailbox money. Like he kind of does your do your due diligence up front, get the investment made, and then you just wait for the check to come each month.
Yeah,
and show up in your mailbox.
Right. I mean, I remember when I started getting into buy and hold rentals, I started off with turnkey. For a couple of reasons. One, I didn't know what I didn't know, and especially investing out of state, I wanted to learn the business. So I started off with turnkey operators, and I think of passive investing as turnkey operate, like multifamily turnkey operation, self-storage turnkey operation, right? Because I'm investing in already operating business, and I can, especially if you want to learn the business, that's a great way to learn the business, is to invest in somebody else's deal and get insights on the deal. But really at this scale, the passive investing scale, that is true mailbox money. Like, I was on the operating side during COVID. I was general partner on a few of these larger assets that are in our portfolio, and that was interesting for a few months to figure out what was going to happen, like with in several jurisdictions, like what's going to happen in the eviction moratoriums. I was also general partnership over a few multifamily assets that in Dallas, Texas last year. You think about it, a year ago, Dallas, and Houston, parts of Texas, the power grid went down. The passive investor, they weren't getting the phone calls and multiple times during the day saying, hey, listen, the pipes have frozen and the water's broken, and I've got leaks in my apartment. Rightfully they're concerned, and we can go into more details about that, but whenever you invest passively, you're giving up that day-to-day operational control and handing it over to an operating business that knows how to handle those situations. And that's probably one of the very key points about passive investing, is knowing who you're investing with. And we can touch on that here in a second. I've got a slide on that. But Scott and I were talking a couple weeks ago when he asked me to speak here. He's just like, well, what's your experience been in this transition? And really, I just wanted to kind of bring some metrics to the table. In my experience on my active side, which I still do, my single family short-term rentals, it's a controlled asset. I'm the CEO and the COO. I'm operating these assets. And it's leveraged time. I'm not going to lie. I mean, I don't spend 40, 60, 70 hours a week managing these assets. I probably spend, with property management, somewhere between 10 to 15 hours a month managing these assets. However, if there's an issue, like on one of our multifamily properties 2 weeks ago, we had a boiler break that in the middle of the night. And so, of course, we spent more time there trying to figure that puzzle piece out. And we net probably seven to 8,000 in cash flow a month, and that's after all debt, expenses, property management, everything's been paid. So not too shabby. But on our passive investments, where I've invested in an operating business that holds multifamily assets, I've invested in an asset where I don't have day-to-day control. I'm trading, time for a return. And I probably spend 10 hours a year just managing all of those passive investments together. Okay, and this isn't 10 hours a year per asset. This is all assets together. And it nets us about 11,000 in cash flow a month. And so you can see, I'm probably, for 120 to 180 hours a year, we're probably earning, somewhere around $48,000-$50,000. But on, for 10 hours a year, I'm earning probably $120,000 a year. So the difference is that my capital is invested in earning a return in both strategies. One is just far more time leveraged. So there are some steps if you want to get involved in passive investing, right? Especially if you're coming from the active side. I've talked to hundreds of investors that have made this transition, and there's a pretty common obstacle that they all hit. And one is that they get really starry-eyed about a deal. Okay, if you've invested in your own single family or small multifamily property, you're the day-to-day operator. You might be getting 30, 40, 50, 60% returns on that asset, but you have a big time involvement there. You also don't have the ability to scale quite as far as you could. Now, when you make that transition over to passive investing, you're going to share in the returns with the operating business. So, but the biggest thing is we can't look at the deal first. We need to flip the business model on its head and look at the operator. But there's two steps before we need to jump in to look at operators, and that is you have to understand what your investing goals are. Do you need cash flow? Do you want to build a net worth? Okay, what are your goals? Do you need some sort of blend of both? Now, here's the thing. For me, I have a very particular strategy on how I invest. I always look for assets that have cash flow to them now, especially in today's environment. And the reason is that it tells me that it's profitable today, and I have wiggle room to respond in the market, should I need to adjust like my rental prices to stay competitive. You also need to understand your risk tolerance. When we talk about syndication investing, I mean, multifamily, self-storage, mobile home parks, residential assisted living, car washes even, they all have a different type of risk profile to them. And then even within the investment, say like we were just focused on multifamily investing, there's a risk profile there across the classes. So think Class A suburban affordable housing. That's where we choose to stay, where we choose to invest as passiveinvesting.com. There is, no deferred maintenance, very minimal CapEx expenditures, happening on these projects. Our business plan risk is very low. We're essentially buying a stabilized asset and quote unquote clipping a coupon along the way, but it's cash flowing. It's stabilized and it produces a return now. Whereas you can swing the pendulum the other way and go for more of a C-class development asset where it may not cash flow right now because you need that cash flow to support the development side of the project as you move, complete your rehabilitation, but also move your rents closer to market rents. But there's a business plan risk that happens there. If you're doing that kind of deep value add strategy, what happens, when supply chains get disrupted? What happens when labor gets disrupted? What happens if your rents don't prove out, your rent increases don't prove out in the market like you had underwritten? So, and there's not a right or wrong strategy here. It's just you have to understand who you are as an investor. Okay. Once you have those two, points 1 and points 2 kind of covered, now we can start looking for operators. I like to think of it like a sales funnel. Okay, we're trying to get you to focus and move like the, dial down into the funnel, right? We want to look at only those operators that meet your investing goals, meet the risk tolerance that you actually personally want to take within your portfolio. And once you understand that, now we can start going after and finding those operators that meet your goals and your risk tolerance. And then you're going to jump on the phone and get to know them. Who are they? What is their business plan? What is their track record? Who is on their team? How many deals have they done? How many deals have they cycled out of? What are their returns have been? What markets did they invest in? Why did they invest in? What strategy did they invest in, and why? I have a free tool for you guys at that website that I shared with you, passiveinvestingwithwhitney.com, that walks you through all these different questions on how to vet an operator when you're on the phone with them. And then once you kind of identify an operator, what markets are they in? I look for operators that are in high growth markets where the population's growing, incomes are growing, big businesses moving their headquarters to, jobs are growing, jobs are diversified. There's not a one trick pony show, only one large, employer in town, or two large employers that if something happens with them, the town, stumbles. Okay, we're looking for large metropolitan service areas that are very well diversified. I also look for markets where it's pro-business. Okay, not in this kind of plays into two different areas, but one where that's pro-business on taxes, and also pro-business on landlord-tenant laws. Okay, I want to have flexibility on how I work with my tenant. Okay, and create custom plans on how I work with them. Okay, once you get kind of steps 1 through 4, under your belt, now it's time to start looking at the deal that operator has. Okay, otherwise, and like I said, a lot of people try to get on like 100 operators list, and they're looking at deals, and then they never get invested in any one of them because they're coming at it from the wrong direction. Okay, so once you identify a deal, and I actually have a webinar, Scott, I can share with you the link if you want to share it with people on how to vet a deal.
Yep, I was gonna say, yeah, please share that link. That would be, I would say, very helpful, very helpful for individuals. And I did have a quick question, Whitney, before you get into vetting the deal. As far as the market, as we kind of sit here at the beginning of 2022, are there certain markets that you're seeing that you as an experienced and seasoned investor are seeing a more interesting, better, hotter markets to be at least in 2022 that maybe aren't, weren't hot markets a few years ago?
I think, at least for the past like 4 or 5 years, the southern, what we call the Smile area in the United States is, still holding up very well. It did very well through, COVID as well. We look at North Carolina, South Carolina, Florida, Texas, those are, again, we're looking for those core fundamentals of, the growth, where our population's growing, jobs are diversified. And then also like the pro-business areas, tax-wise, landlord-tenant-wise. We continue to look at other areas, like Phoenix is interesting. We're currently in Houston in Texas, but other areas of Texas are also interesting as well. But that kind of core market area is, kind of like our bread and butter.
Okay, and actually another question too on the kind of a step 1 and 2, knowing your goals and risk tolerance. Is that something that you kind of as with what you do with passiveinvesting.com kind of help people when you talk to them as an investor who's looking at a project? Do you kind of analyze that part, or is that something people need to maybe do independently before they get to the step of actually talking to an operator? Are operators going to maybe help talk to an individual about their goals, their risk tolerance?
So that's a really interesting, question, and thank you for asking that. So, operators generally are not financial advisors, right? So we can't advise you on what to do. Now, for me, I'm in a unique position where I'm not doing any sort of capital raising, so I can take my hat off and my like little operator hat off and, kind of talk more openly around like questions that you need to consider. And so what I like doing, coaching is kind of like a natural, skill for me, is I like asking questions to get people thinking on like what it is they really truly want from their assets. And you'd be really surprised how many investors haven't asked themselves these core questions. Even when we get down just to the fundamental ones that I presented, like, do you need cash flow? Do you need, a capital gain, the growth in your net worth, or do you need a blend of both? Like a lot of people, are just, they haven't even thought through that far. But yeah, that is something that when we jump on the phone, I can actually kind of help, lead people through a line of questioning to just really get them thinking about what their true needs are, not only to, for tomorrow, like thinking in terms of retirement, but also today. Like what are those things that we can lay the groundwork today to help them meet their goals for tomorrow.
I think that was a great answer. Like I said, I think that's something that's important for investors to think about. Kind of, if I have this chunk of money, what do I want from this money? Do I want this to just grow over the next several years and it's there for me down the road, or do I want some returns now? So I think that's a great analysis to have with especially an individual, but also then in talking to other people who've been there and done that before you. So
Yeah, and really, I've seen people get into like really long investments, 10, 15, 20-year, type investments, and we don't know what the environment's going to be then. We don't even know. I mean, COVID proved we don't even know what it's going to be like next year, So, really like, how can we think like in both the short term and the long term, and, help get access to investments that can cycle out in like 5 to 7 years. We haven't even touched on it, because it doesn't really apply to, retirement accounts, but there's a whole reason to, invest passively for tax benefits. You get the exact same tax benefits as if you invested actively. Now, if you use your retirement account, all those tax benefits stay suspended in the retirement account. And usually we like, point people back to their accountants and their custodians for, more advice on that. But sometimes even like evaluating the goals is like, what do you need tax wise? Do you need tax breaks right now? I've jumped on phone with investors and they're like, I need like, depreciate, $70,000 of depreciation this year. And then they're investing in their retirement account. I'm kind of like, hey, let's go back to your accountant and like ask these questions of them, because I can't advise you on the answer to this question, but let's make sure that we're getting the right questions answered so you can invest in the right way that will help you meet your goals.
again, great points. We've said certainly speaking from the IRA side of things too, individuals who, if you're going to put some money into a deal because you want that, hey, this investment's going to start paying me every month, and I want that cash now. Well, then maybe the IRA isn't always the best place for that. I mean, the IRA is great if you have the money there and you don't need the income now, but you want to generate a better return for the future. So yeah, good. I think these are all great questions for people to ask. So I guess after kind of know your goals, your tolerance, you're vetting the operator in the market. Maybe I guess talk next on your step was you're vetting the deal. So I'll let you get back to your presentation.
Yeah, so I'm vetting the deal. I mean, this is like, this is a big, really big topic, and it varies, whether we're looking at multifamily, self-storage, notes, what, car washes, right? So that's where I offered up the link to a webinar that I did on how to vet a multifamily deal. I spent an hour of going through my methodology, but, really this boils back to like, what type of deal you're looking for to put into your portfolio. You're going to, if you're looking at Class A, you're going to vet a deal one way. If you're going to looking at Class B, you're going to vet it an entirely different way. If you're looking at Class C deals, you're going to even have a different strategy for vetting the deal. But, and in the end, what you're looking at, from a multifamily standpoint, you're looking at the number of units that the deal has. If you're going to invest passively, I like deals with 100 units or more. There's an element of scale. You can have full-time employees on the property, full-time handyman. You can have a full-time leasing agent. That just gives you a better way to, the operator's going to actually create a community there, a self-sustained community. You're going to vet You know, the business plan, like, is, you know, what are the fees on the deal? What are the, you know, is there a construction piece on the deal? You're going to vet all the different mechanics of the business plan. And then you're going to get into the returns, like what kind of returns are on the deal? IRR, ARR, cash on cash. What is it? Does the deal offer a preferred return? What is the equity multiple? What is the hold time? You know, so that just helps you when you have a structured, you know, way to vet a deal. That actually helps you compare apples to apples, you know, pretty readily. And you know, because if you're looking at multiple deals, you know, you need to make a decision on which one's going to fit in your portfolio, you know, more readily. And then once you have a deal that you vetted, that you've gotten all your questions answered to, and you're ready to pull the trigger to invest, place your commitment. We are seeing deals fill up very quickly right now. Cash, there is a lot of cash looking to invest in deals right now. So if you have a deal that lands on your inbox, you know, if it lands on your inbox on Monday, don't wait until Saturday to underwrite it. Carve out some time, like in the next, you know, 24, 48 hours, and at least get to that high level yes or no. And once you have that, because you'll still have more time to do, you know, more thorough due diligence when you get the legal documentation. But get to that high level yes or no so you can place your commitment and actually kind of earmark your spot in the deal. Then once you place your commitment, you're going to get access to the legal documentation. So, you know, we call this the PPM, but really it's actually 3 different documents combined together. There's the subscription agreement, the operating agreement, and then the private placement memorandum. And so, you know, if you're investing individually or jointly or through an entity, you can complete those documents on your own. If you're investing through an IRA, like Advanta IRA, you need to partner with your custodian and get them the documents ASAP so they can help walk you through the process of getting that document filled out correctly and getting funds lined up to fund your investment. Number 8, once you complete the documents, make sure that you fund your investment. There's a funding deadline for a reason. I think investors, you know, sometimes are a little puzzled why the funding deadline is 2 to 3 weeks before the actual closing on the deal. And this is just so the operator can complete their accounting on the deal. I mean, there's just so much paperwork and so many moving pieces that go into closing a large multifamily building or self-storage property. You know, it takes a couple weeks to get through all that accounting. So make sure you understand the funding deadline. You're working to get funds in on time or ahead of time, and not scrambling at the last minute to get things funded. And then number 9, you know, once you're funded, technically you're done, right? You can kind of like wipe your hands and sit back and collect that mailbox money. But I really encourage investors to stay knowledgeable and engaged. And so you're going to start receiving several different pieces of communication from your operators. For me, I love investing with operators that are going to let me know the asset that closes, when it closes, the day it closes. I also want to receive monthly communication and quarterly financials on the asset. Now, do I get to day-to-day manage the operator? No. Okay, that's why I'm investing with them. That's how they're earning their monies on the deal, is by managing the day-to-day asset. However, I get to ask questions as a limited partner because I am a partner. I'm a partner in the deal. And so just make sure you're reviewing this communication and financials. And, you know, every once in a while, there's an ask in there. So, you know, maybe like after a year or 2 or 3, maybe there's a refinance and the operator needs you to inform them on how you want your funds to be distributed. Maybe there's, you know, asset prices, you know, continue to stay stable or go up like they are. Maybe you have an asset that sells. That's going to be in that monthly communication. So make sure that you're receiving that communication and reviewing it on a regular basis. Now, like, how do you make money? That's also a big question that people ask me. It's just like, okay, I've invested actively. I can earn a 40, 50, 60, percent return on my own. Why on earth would I go in a passive deal? Well, if the leverage piece isn't enough, you can make money in a very leveraged way. Normally, just at a high level, and I can speak for our deals at passiveinvesting.com, we offer what we call a preferred return. Okay, that's the first investment hurdle, and our preferred return right now is at 7%. And then we also, share in splits and profits with the limited partner on both the cash flow and gains. And so we actually, I should back it up. We offer two different tranches on most of our deals, either a 9% preferred return, no participation in any of the profit sharing, but you get a larger cash flow upfront. Maybe you want that. Or you can participate, take a lower preferred return at 7%, and then split in the profits 70-30 with the general partner. So that's just for our deals. That's gonna, change operator to operator. Now, how does this plan out? Well, I just, this is the deal that I invested in as a limited partner with passiveinvesting.com a few years ago. It was a 2-year hold. We just, took advantage and got the property sold this year. We essentially earned our 5-year return in 2 years. So why not go ahead and sell and, play Monopoly and move up into a larger asset? I invested $50,000 in that deal. Over the whole time, I earned $7,326. Okay, maybe not life-changing money, but hey, that was money that I didn't have to do anything for. And let's just do some quick math. 7,326 divided by the 5 hours I put in for due diligence. I was earning $1,465 for 5 hours of investment. Then I got a gain. Okay, when the asset sold, I took a gain, or I earned a gain at $37,800. So essentially, for 5 years, for a 2-year hold, 5 hours worth of due diligence and work and reading, what I estimate into all the updates and filling out the paperwork for the 1031 exchange, I earned a 1.9x equity multiple in 2 years. You can make money passively. All right. So again, I have to say, returns may not be typical, right? Past performance is not indicative of future returns, but this is a pretty typical structure on, between earning a preferred return and a gain. Maybe closer to 5 years as opposed to 2, but this is pretty typical. I mean, again, this is pretty leverage, leverage type of investment.
Whitney,
So,
if I have a quick question for you before you jump on and then we wrap up, I guess in a few minutes. But you mentioned obviously operator to operator, the splits, the preferred return, how they split the profits, et cetera, is going to vary probably a little bit here and there. Is there anything maybe for somebody who's looking at investing, a newer investor, something they should be wary of if they come across a deal the way it's structured with the returns? Is there any potential kind of, not necessarily a red flag, but maybe just hey, this is maybe not the best way to go about it that you've seen kind of in your years of investing on how an operator may structure returns that, again, for the new investor, maybe not the best way to go about their first deal or even maybe subsequent deals?
yeah, definitely. So for number one, I'm not a fan of operators that don't offer a preferred return. Now, you have to think about it. A preferred return is not guaranteed, right? I actually don't like the term preferred return. Okay, I just like it called pref because what it is, it's a hurdle. It's the first hurdle that the operator needs to clear before they can start sharing in the profits on the asset. Okay, it's an investment hurdle. That's all it is. But for an operator, if they're not going to offer a preferred return, I'm kind of like, my question as a limited partner is like, why are they not that confident in their deal to where they're not willing to give the first 6, 7, 8% to me? So I can, they can take care of me first. So that's kind of like, it is a little bit of a red flag. Okay, again, it doesn't mean that it's wrong. It just I really question when I don't see a preferred return. Okay. Now, when we get into the splits, Okay, the typical split that I see these days on just kind of your standard multifamily deal is a 70-30 split. So 70% going to the limited partnership, 30% of the profits go to the general partnership. Now, sometimes you see 80-20 splits, okay, maybe with like a newer investment group, maybe they'll give up more. Then you might see with the more seasoned investment groups, investment splits of 60-40. I always want to question is what is the business plan? Okay, what if I'm giving if we're splitting 60-40, what work is the general partnership really doing to earn that extra split? Okay, if they're buying an A-class asset and just sitting on it, why? Right? If there's no like business plan, value add that they're creating with the business plan, like why are they commanding a larger split? So it's that 70-30 split tends to be pretty balanced right now that we're seeing in the environment, this particular space. If it goes up or down, I want to know why. Okay. Now, there's a whole thing back here. This is like passive investing 201. And I actually have small little videos on this on our passiveinvesting.com YouTube page, just to define terms. But one of the terms that you want to really kind of get familiar with, if this is a strategy you're going to pursue, is what is called the waterfall. Okay, so in that it's not only the splits, but also who gets caught up in their splits and when. And there's a particular little red flag in here. If you see a GP catch up in there, you want to understand when that happens and why it happens. Okay, so again, this is like getting into this is beyond fundamentals passive investing, but that would be another like red flag. We don't do that. We catch ourselves up after everybody else is made whole. So, but sometimes the general partnership actually catches themselves up before other parts of the waterfall, the limited partners made whole. That I don't like seeing. It doesn't create what I call alignment with the investor. I really there are plenty of operators out there that put their investors first, and it's just go find one of those.
Okay, thank you for that answer. Yeah, no, I know we're getting close to the end of the time. I want to obviously give you time to finish up your slides. So thank you for that answer. That was very good.
Yeah, absolutely. Well, yeah. So I mean, really, I just hopefully you guys have gotten a lot of value out of today's presentation. Really just trying to help you kind of paint a picture that you can go from active investing into passive investing. It might have a place in your portfolio. It's not. Hopefully, I've demystified it for you that it's not as scary as it looks. But we can help you do that at passiveinvesting.com. I mean, to date, we have over 820 million of multifamily assets in our portfolio. We have just as much as over 800 million closed at the end of the month of February on the self-storage side as well. We have 3,700 plus multifamily doors. And then what I get to do every day is work with our investor base. And anyways, again, I want to provide value and resources. If you are looking to dive in deeper on these type of topics, join the Passive Investing Made Simple webinars. I do a weekly webinar on on Tuesdays. And so, you can join me. I'll give you the website. You can go register, get access to all these free things. But also, if you just want to learn more about passive investing, get plugged into these webinars, join me there. And you can go to passiveinvestingwithwhitney.com.
All right, thank you very much, Whitney. I thought it was a great presentation. I think really good information for someone who's looking to get started and looking at passive investing and needs to know the ins and outs. I think that's a great resource. I thank you for sharing that. And people can find out a lot more about, like I said, getting beyond 101 and the fundamentals, but getting into those 201 topics as well. And appreciate you being a great resource, obviously for our clients and our contacts who want to learn more about it. Any final thoughts before we close out?
It's if you're interested at all in passive investing, set aside a couple hours to just read about it, join in on a couple webinars. reach out to me directly. And, I can just really, I've been in the space for quite a while, both as an active investor, but also a limited partner. And so I can really help you, demystify like if this is the right fit for you. And then if so, like what might be some good resources. For me, it's not a hard sell. I'm just so passionate about helping people, figure out how to, make the most out of the resources they have so they can achieve their dreams.
Thank you. And I think that's, again, great offer for you to provide that time. I think for people who are looking to make the transition, especially someone who's looking to make the transition from an active, say, rehabber to someone, hey, how can I make my money work for me instead of me working for my money? Whitney, you've done it. And so I think reaching out to you and sharing that and you're being able to share what their situation is and your background is going to give them a great insight to what's possible and how they might be able to change a few things within their portfolio and certainly allocating their time as well. So thank you very much again for joining us today.
Yeah, definitely. Well, hopefully everybody understands it's not a question of either or. It's an and, right? There's space for it in everybody's portfolio, and it can be a really powerful tool if leveraged correctly.
Absolutely. Yep. So Whitney, thank you very much again, and thank you all for listening to this webinar today. If you have any other additional questions on self-directed IRAs, or if you want to listen to this recording again, you can certainly visit it on our YouTube page, or our Advanta IRA on Demand channel. So thank you again for watching.